Welcome back to the world of investing. So today I'm going to be talking about the Federal Reserve and basically its impact on economics and investing. I previously discussed the Federal Reserve and specifically how they've attempted to combat inflation, and I feel that it's, pretty important to further understand what they do because they obviously play a significant role in our economy. They have a great influence in the stock market. Their actions can drive up prices or drive them down. When I'm on my brokerage account on TD Ameritrade and I scroll the news section, I commonly see the words "the Fed" come up, and I'm guessing you guys do too. So I want to explain more what it is, and so you understand what exactly is going on in the news and who is causing certain things to happen. So before we dive in, I want to mention what the Federal Reserve actually is. So it's the central bank of the United States. It was established in 1913, and its primary role is to basically act as the guardian of the U.S. economy. And as I said, it plays a instrumental role in influencing the financial markets and the decisions of certain investors. That's when you look in news and basically their actions can influence if you want to invest or not. So the Fed has more power to affect the economy than any other institution. They have the power to create money, buy trillions in government bonds, and act as a lender of last resort. They also have weaknesses, though, and through their monetary policy, which is the Fed's actions, um, they can really only impact real growth in the short run. So this does not really impact the real GDP. In that, if you guys don't know what that is, it basically shows us actual price differences over time. Um, and basically, they can't. So back to the Fed, they can't impact growth very long run. So at times, with that being said, the Fed has made the economy worse due to incomplete data, lagged results, and lack of direct control. Those are a couple examples. So I guess the question should be, why is the Fed so important? And in order to answer this question, we need to grasp its three key functions. The first one being monetary policy. So the Fed has the power to control the money supply in the economy. By adjusting interest rates, they can influence borrowing costs, which in turn impacts spending and investment decisions, like I previously said. Um, and obviously, this is a powerful tool in managing inflation and basically stabilizing economic growth, which they have been in the process of doing for the past couple of years. If you look over data, specifically the federal funds rate, and that is overnight lending from one major bank to another, so interest, as well as inflation, you can see that the federal funds rate has increased a good amount over the past couple of years as the inflation rate has risen. This has been the Fed's attempt to combat inflation. They have the ability to change the federal funds rate through their control of the money supply. So going back to understanding or answering the question we previously posed, the second function would be banking oversight. So the Fed ensures the safety and soundness of the banking system. It supervises and regulates banks to prevent financial crises, making sure they financial crises, making sure they follow the rules and have enough capital to absorb losses. The third function is financial services. So the Fed is I would say it's like the banker's bank, if that makes sense. It offers services to banks, the U.S. government, and international institutions. And these services, to keep it simple, help keep the financial system running smoothly. So I guess to connect the dots and go back to the start, what does this really have to do with investing and your investments? Well, first with the monetary policy, when the Fed adjusts interest rates, it directly affects the returns on different investment assets. So, for example, when looking at the stock market, when interest rates are low, borrowing costs are low, which can boost economic growth. This often leads to higher corporate profits, which in turn can drive up stock prices. So, investors often see gains in their stock portfolios during periods of low interest. The second example, bonds. So, on the flip side, when the Fed raises interest rates to combat inflation, bond prices tend to fall. And this can be a concern for bond investors who may see the value of their fixed income investments decline. So, the third example is going to be banking oversight. The Fed's role in supervising and regulating banks helps maintain a stable financial system, and this is important for investors. When looking at the 2008 financial crisis, it's obvious that stock markets can experience significant downturns. The Fed's actions, such as providing liquidity to banks and implementing stimulus measures, can help prevent a full-blown economic collapse and limit the damage to investors' portfolios. Going back to the Fed, before 2008, they conducted policy by targeting the federal funds rate, which is overnight lending from one major bank to another, with open market operations. And banks did not have much incentive to keep excess reserves. It was above and beyond what was required by the law. They found themselves with too few reserves, so they basically borrowed reserves from other banks. That's the federal funds rate. And the Fed changed the supply of receive until federal funds rate was exactly where they wanted it. So in theory, interest rates move together across an economy. In practice, movement is looser. So the Fed's communications is an important tool in influencing the economy and, I guess, influencing interest rates. So to reiterate, before the Great Recession, which was the financial crisis of 2008, that's what I'm referring to, not back in the 18th century, not back in the 20th century. The financial crisis of 2008, the Fed usually changed the supply of bank reserves to impact interest rates of money supply. So when looking after the financial crisis of 2008, the Fed basically changed the way it worked. So after 2008, to stimulate the economy, they conducted quantitative easing, and that is when they swapped money for assets other than T-bills, treasury bills. So this basically allowed the Fed to impact different interest rates, longer term interest rates, and target certain parts of the economy, unlike before where they were kind of targeting shorter term interest rates. And this helped the Fed ensure that lower interest rates translated into lower mortgage interest rates, and that helped home buyers as well as spur the purchase and creation of new homes. And the 2008 financial crisis basically revolved around real estate market and its crash. So qualitative easing also increases supply of reserves of banks and increases liquidity. And this example with the 2008 financial crisis basically shows the power of the Fed. It highlights their power. They can change the way they work to help the economy, and this obviously has implications on the stock market and stock prices. With this example specifically, the Fed worked to combat recession and help stabilize the economy. And as a result, stock owners would recover from damages to their portfolios, although maybe they did not fully recover, but the Fed helped them a little bit. So lastly, the Fed's role in providing financial services keeps the financial system efficient and effective. This indirectly benefits investors because it ensures that transactions and financial markets run smoothly. An example being efficiency. So I guess imagine trying to buy or sell stocks, bonds, or any other financial asset in a system with constant glitches and delays. So the Fed's role in maintaining financial infrastructure helps prevent such scenarios, providing investors with, I say, confidence in the functioning of the markets. So whether you're directly invested in stocks and bonds or indirectly, for example, through retirement accounts, mutual funds, the Fed's actions and policies have a substantial impact on your financial well-being. So in conclusion, the Federal Reserve is not just an obscure institution with no relevance to your everyday life and your stocks. It plays a pivotal role in shaping the economic landscape, influencing interest rates and ultimately affecting your investment decisions and financial security. That's going to be all for this episode. I hope you enjoyed, and thanks for listening.